understand that depending on the stage you're at in your business, there may be times when it makes sense to provide a personal guarantee. That doesn't necessarily mean it's going to hurt your credit. It won't be reported on your personal credit unless perhaps you default, then they might choose to report it at that point. But it is added personal risk. So you need to be wise about it, smart about it. If you're pledging the home equity, your partner or spouse needs to sign off on this and be on the same page as you. And I've heard some horror stories on that. So you definitely want to make sure that you weigh the pros and cons.
Having good business credit means everything when you're trying to grow. It's tied to having contracts, to getting lines of credit, capital expansion, selling your business, or acquiring other businesses. In today's episode, we're speaking with Gerri Detweiler. She is the world's leading expert when it comes to business credit. We're going to talk about what you can do to establish your business credit, how to get lines of credit so you've got access to capital, and then we're also going to cover some of the more advanced pieces that you can take to continue to grow your business, possibly acquire other businesses, or prepare yourself when it comes time to sell. This is one of those episodes where you are going to want to take notes. And there are a lot of details and pieces that will really help you skip the line and a lot of the hassles that happen for business owners that can get stuck and simply quit. This is one of my favorite episodes. Let's jump into it right now. Gerri, welcome to the podcast. It's a pleasure to have you.
Oh, glad to be here.
You're back by popular demand. You've been on a couple of times, and your episodes about business credit are some of the more popular episodes that we have. And for me, I wanted to bring on the world's leading expert with this. And you're in the hot seat today. And hopefully what we can get out of that is that we'll be able to help business owners that may be new or business owners that already have an established business to access capital or additional capital. Does that work for you?
That absolutely works for me. And what I really would like to do, Spencer, is just to make it as easy as possible. I think there's so much information out there now that makes it seem like a complicated, mysterious process. And it doesn't have to be that way. So we'll try to break it down and make it simple.
Excellent. What would you say is the overall confusion and the points that make it mysterious for people out of the bat? And then we're going to go on a checklist of what things people can do.
There's a lot of information that makes it sound like you have to follow particular steps in a particular order. And if you're going to get lots of business credit, this is the exact way to do it. In fact, it's a lot like personal credit in that good credit references, accounts that are paid on time without too much debt, build good credit. So it's not that you have to get this specific mix of credit or vendors that you do business with, and we can talk about vendors, but more it's the overall approach to just being proactive about it and making sure that you have accounts report. And that's the number one thing that I see, whether a business is brand new, whether it's 10 or 20 years old. Typically, the low credit scores, unless it's something negative, you've had collection accounts or a tax lien against the business or a judgment, more often than not, the low credit scores are businesses that don't have much business credit. They just don't have accounts that are reporting. And without that information, the Bureau can't really create a robust credit score. So that's really the step that I want business owners, no matter what stage they're in, not to overlook.
Okay, that's great. And so you mentioned a couple of things in there that if it's a brand new business or if it's a business that's existing that has, we'll call it a 20-year-old business, both of those may not have business credit. Is that correct?
That's correct. And it's not unusual to see established businesses that don't have a good business credit rating because they don't do business with companies that report their payment history. It's very fragmented in the business credit world, unlike personal credit, where you go and get a mortgage, it's going to show up on all three of your major consumer credit reports, right? It's just a given these days. Your credit cards, mortgages, student loans, auto loans, they all report to all three. In business credit, they might report to one, they might report to multiple bureaus, they might not report, they might only report negative. So you have to be a little bit proactive to do business with companies that report if you want to build that good credit score.
Okay. So, not to create a checklist that says you have to follow this order, I'm going to run through a few things, referencing some of the past episodes we've done and also reading some of your material. And by the way, any of you listeners, there will be links to Gerri's website, her other material, blog posts, and material that will really help you out. So, essentially, what we're seeing is first, you have to have a business. So, be it LLC, S Corp, whatever that may be. And then you have to have your EIN number, which is your business social security number. Is that the safe way to call it?
Yes. And let me just back up on the business. You can build business credit as a sole proprietor. It is possible. The caution I would say there is if you're going to do that, pick out your name very carefully and make sure that it will translate or adapt to when you do decide to form an LLC or a corporation. And I highly recommend you have a formal business entity. But if you're not at that stage, you want to be able to basically let the credit bureau pull that information over to the new business. And if you don't really have an official business name for your sole prop, and then you form an LLC, there might just be a disconnect there in terms of the credit accounts and how they get reported. So if you're going to start as sole prop, I'd suggest two things. Pick a name very carefully, make sure it's not infringing on trademarks, make sure it's available in your state, and then register it with your state. So your Secretary of State or Department of Corporations will allow you to file what's called a fictitious name, a DBA. Do that so you have that business name on record.
Okay. And for you, from reading previous books that you've written and material, you've worked with people like Garrett Sutton and others at Corporate Direct. Is that a route that you find to be easiest for people to just get up and go and move along?
Yeah. Yeah. So Garrett Sutton is my co-author on Finance Your Own Business. He's a small business attorney and he's on Robert Kiyosaki's Rich Dad team. Great guy. And he helps businesses form business entities, choose the right entity, and then get it started. So I would recommend you do that as soon as possible. I understand sometimes, you're not sure how this business is going to turn out. Maybe it's a side hustle, you're an independent contractor, you're in California where they have that huge $850 fee. I think they've currently lowered that for 2 years, but there's reasons why people don't take that step initially. But as soon as you can, that does help in terms of just building a legitimate business. It also opens up more financing opportunities because some lenders will not lend to sole proprietorships.
Okay. And so once you have that set up, either your DBA or hopefully a corporation, then you're going to have your EIN and then a DUNS. Can you explain the DUNS and then we'll take next steps?
Yes. So the employer identification number you can request free from the IRS on their website. Not all businesses have to have an EIN, but I would suggest you go ahead and do that. And that also could, if you are operating as a sole proprietorship, which means you just haven't formed any kind of formal business entity, that could be used as your start date for your business. You get the EIN and that could be the start date. And then once you have that EIN, then I would recommend you go ahead and reach out to Dun& Bradstreet and get what's called a DUNS number. So DUNS number for them is like their identifier in their system. In personal credit, our social security number is used as one of our main identifiers, right, within the personal credit system. With business credit, each bureau creates its own. And the only one you can proactively go out and request is the DUNS number. It's free. You can go to Dun& Bradstreet's website and request it. You might even do a quick search and make sure you don't already have one. Maybe you do and you didn't know it. Something got reported. You might be in their system. And then it usually takes about 10 days to 2 weeks to get a DUNS number. And that will just simply be your identifier. The reason I'm recommending that is because it can be helpful when you apply for some of the credit that we're going to talk about in a moment to put that on the application to help ensure that your credit file gets associated with your business. Unfortunately, that's just one of the big problems with small business is you have a lot of businesses with similar names, maybe in different states, and sometimes they can get mixed up with others. If you have that DUNS number, that will enhance the accurate reporting to the Dun & Bradstreet Credit Bureau system.
Okay, so that makes sense there. And once you have that, I'm going to throw a wrench in the system for just a moment before we move forward. Some of us have complicated structures, meaning that we have holding companies, and those holding companies actually own the separate LLCs and things of that nature. So in that case, do you suggest someone taking through the extra effort and establishing this business credit and the duns for each and every one of those?
It does depend on the business and your goals, whether you want to take the time to proactively establish business credit for multiple entities. Now, you can have a business credit rating for all of those different entities, and it may just happen naturally because information ends up in their system. But if your goal really is to build business credit and access business financing, I would look at the entity that's most important for that function and where you're most likely to get the most bang for your buck. So, for example, let's say you are a real estate investor, you have 5 properties all in their own individual LLCs. Then what you might have is a management and marketing company. And that's the company where you focus on building business credit. And it provides several benefits, a little bit lower risk than an individual real estate holding as far as the risk ratings go. And also it just gives you a little bit more flexibility. It's up to you how much time and effort you want to put into this, but often business owners, when they're starting out, will take the broad entity and use that to establish business credit.
And speaking of risk, there are certain categories and certain business types, and as you mentioned earlier, certain business names that infer more risk to these accounts. Isn't that correct?
Yeah, I think the one thing to keep in mind is that the lenders who are going to be looking at your business credit and looking at your business in terms of financing, they want to see that you're an established business. And also goes for potential business partners and customers, et cetera. What you want to do is try to focus on making sure your business is as solid and legit as possible and building a strong foundation. What I don't like to see and what I think could hamper you in your business journey are things like using a Hotmail or Yahoo email address for your business, or having a name that's just you, which is fine. You can do that, but think about if you want to grow that business or you want to sell that business, someone going to want to buy your name for the business, or they want something that they can grow or have better branding. You want to grab the social media handles associated with the name of your business. I've had business owners reach out to me who had their business identity stolen on social media, and people have either tried to ransom it back to them, say, "Hey, we'll sell this to you," or hijack their customers because they pretend to be them. So if you do these foundational steps at the beginning, it just helps in so many ways beyond this whole business credit and business financing journey. So that was a little bit of a long answer, but I think what you want to do is pick that entity that has the broadest opportunity and focus on it and make sure that you pick a good name that can translate in other ways for your business. Get the URL, get the email address at mine at gerridetweiler.com, right? As opposed to using a Gmail account. And then establish all the steps. In terms of risk, some businesses are considered more risky than others. For example, real estate can be in a higher risk category simply because of the databases. The credit bureaus can analyze the payment rates and the default rates and the delinquency rates and the failure rates of businesses, right? So they can, if you're in an industry that has a high failure rate, naturally your business is considered higher risk. So in the case of the real estate example, a lot of times, again, they'll create a marketing and management company or something like that has a lower risk profile as the company that they're going to focus on building business credit. Some retail businesses may be considered higher risk. That's not always the case. And some lenders have an appetite for that. Others don't. Retail, restaurants, and real estate are the three that one banker told me are the ones that he has to really scrutinize more carefully because of the failure rate in that.
That makes total sense. And it's funny because in the business buying world, which I'm in, we stay away from retail and we stay away from restaurants like at all times. We avoid it like the plague because of risk as well. So it
Yeah.
totally makes sense. You're talking about establishing that business credit. And there are some areas where it's easier to establish that credit. And then we'll talk about personal guarantee and no personal guarantee. But can you take us down that rabbit hole for a little bit?
Sure. So let's first talk about personal guarantee. So personal guarantee is where you agree to be personally liable for the debt of the business if the business does not repay that particular type of financing or loan. If you are a sole proprietor, it's all personal guaranteed, right? Because there's no legal separation between you and the business. So you're putting your personal guarantee on everything. If you have an LLC or an S corp, And you can find lenders that don't take personal guarantees that can allow you to just take on the debt in the name of the business, and the business assumes all the risk for the debt. For the lender, that's higher risk because they know that when individuals, business owners have skin in the game, they are going to probably prioritize a particular bill. So I'll give you an example. Business credit cards can be a great way to establish business credit, and they have other benefits. All of the major credit card issuers, all of them, Amex, Discover, your Citi, your Chase, they're all going to, Bank of America, they're all going to require a personal guarantee on those credit cards. Now, there are some corporate cards that don't require a personal guarantee. And typically, when that happens, it's because they're underwriting the business based on really solid revenues. Without a personal guarantee, it's an incorporated business of some sort or an LLC, and it has a track record of making money. And that's where the lender can avert the risk by seeing the business's history. So there's always a bit of a trade-off here. Banks in particular, including for SBA loans, love personal guarantees, and they will try very hard to get them. Very often it's the businesses that move up to the next level. In a business credit card world, it's 2 to 4 or $5 million in annual sales before you move to the corporate card version of that typical small business credit card. That's not true of all the corporate cards that are out there. There are challenger cards that don't have those requirements, but the names, they typically have high revenue requirements. So understand that depending on the stage you're at in your business, there may be times when it makes sense to provide a personal guarantee. That doesn't necessarily mean it's going to hurt your credit. It won't be reported on your personal credit unless perhaps you default, then they might choose to report it at that point. But it is added personal risk. So you need to be wise about it, smart about it. If you're pledging the home equity, your partner or spouse needs to sign off on this and be on the same page as you. And I've heard some horror stories on that. So you definitely want to make sure that you weigh the pros and cons.
Okay. So you've helped establish, I feel like, a pretty good foundation. And what we'll do is we'll put some of these steps and resources inside of the notes of this podcast. So any of you can go and refer to that. What I want to do now is cross the chasm and get into some more deeper details. The stuff, that's why you're the expert at this. So help us understand a variety of businesses. Some businesses are very cash heavy. Some businesses do a huge amount of revenue, but their profit margins are small. So all of these elements look different in the business credit world. Help us understand that, because our goal is to get business owners access to capital so that they can grow as much as possible. With the caveat, obviously, we don't want anyone to get a ton of business capital just to go and default on it. This is all for good purpose. There's our disclaimer in place. So help us cross that chasm.
Yeah, and I'm glad you mentioned the last point, because I think that's where I run into questions about this business credit building process, where people almost make it the goal itself. The goal is not to build the goal. You want to build business credit, but the goal isn't more and more business credit. The goal is a bigger business, right? A business that's making money. So I don't want you to spin your wheels and waste a lot of time if it's not necessary. So given that, the financing world for business is confusing. It's frustrating. It's very different than consumer credit. We have our buckets in consumer credit, right? You get an auto loan, a mortgage, a student loan, a credit card, maybe a personal loan. That's pretty much that world. Business loans, you have a lot of different types of financing. They use different terminology and different qualification criteria. So it can be pretty overwhelming. I'm going to be perfectly honest to business owners. It can feel very overwhelming. But I'll give you just a couple of foundational points, and then we can talk more specifics if you like. The one is, the faster and easier it is to get financing, the more you're probably going to pay for it. So the lower cost financing and the better terms are going to probably be things like your bank, credit union, if it offers small business loans, and any SBA guaranteed loans, which you actually get through financial institutions like banks for the most part, except for disaster loans. So those loans are great, and it can take you a month or longer, a couple months sometimes, to get approved, and you're going to have to provide a lot of paperwork. So if you need money quickly, or if you're just going to dig up those tax returns and all those bank statements and everything they're asking for and share a business plan, then a bank loan's probably not going to be for you. I was at a conference, Spencer, where I sat next to a banker and he was trying to close a loan for a client they've been working on for 5 months. It was a lot of money and it was really important to this client. And the client was angry and upset because the loan wasn't closing. And the banker went right down the list and said, look at that email I sent you 3 months ago. Here's the documents I said I needed. We still have not received them. So be realistic. If you're just not going to do that, then don't go down that route. Now, in terms of online loans, the way they can make it faster and easier is typically by linking to your data. So that may include, for example, linking your business bank account so they can analyze the activity, the revenues, the low balance days, how many different sources are paying income into the business, or is it just one or two clients once a month? Those kinds of things allow them to make much faster decisions. But because they don't have your tax returns and maybe all that history or the business plan, it's probably going to be at least a little bit, and sometimes much more expensive than a traditional bank loan.
Okay, that makes a lot of sense. And so let's talk about time. So we've got business owners that are just starting out. At the beginning of this episode, we talked about businesses that may be established, but they didn't set up any of their business credit or anything of that nature. What are timelines? What should people expect?
Sure. Let me just emphasize, first of all, there are three main things that lenders look at: time in business, credit, and or revenues. Revenues we just mentioned, they might ask for business bank statements. They might want to link to your business bank account, maybe link to your accounting software. That isn't always up to date, except at tax time, right? Everyone gets up to date that. So time in business is a big factor. And some lenders just will not lend to a business if it's not 1 or 2 years old. So for startups, you're going to have to be a little bit more creative. So if you are a startup, and I may be going in the wrong direction here on time, but we'll stick with this and then you can correct me if this wasn't what you're asking. But in terms of time in business, if you're a startup, what I would recommend is that you look at business credit cards because those are available the moment you start your business, as soon as you start your business. Obviously, things like friends, family, and savings are another one. And then crowdfunding for certain types of businesses may be an option. Crowdfunding is available to brand new businesses. There's a fourth option that might be available to you depending on your geographic location, and that's called microloans. And these are loans by nonprofits that are usually trying to spur economic development in a community. They're a little bit hard to find, but we can share a link in the show notes. I have an article that goes into detail on how to find a microloan, but a lot of times your local SCORE chapter or your small business development center can help you find microlenders in your area. Now, as your business becomes more established, more options open up to you. Now, where business credit plays a role here is that I found that business owners can probably start getting a decent business credit rating in as little as 6 months if they're proactive with some simple steps that we can talk about. It doesn't take that long to start establishing business credit. That doesn't mean every lender is going to look at that and say, oh, that's fine with us that you only have a 6-month history. Some lenders are going to want to see a longer history, even if the credit rating looks solid and the bills are being paid on time. But it doesn't necessarily take as long to build business credit as it might on the personal credit side, depending on your strategy. And you can build business credit even if you don't have great personal credit. So there are options that don't check personal credit that will extend business credit and will report those payment histories. So you can be working on this at the same time that you're working to improve your personal credit, which I would highly recommend if your credit scores are below, say, a 650 or so. You probably want to be working on trying to get those up.
Okay. One other piece, this is probably a little bit more advanced, but there may be some listeners asking about this. For business owners, you've gone into a new industry and you want to have that established history and you don't necessarily want to start a new company. So you can go down the route of purchasing an existing company. Either we'll call it an acquisition or shelf LLCs and things of that nature. Can you go into those for just a bit?
Yeah. So when you purchase a business, that could be advantageous to you, but I would recommend checking that business's credit history. The good news is you can check it, credit history on any business. So there's no restrictions on who can look at business credit. So that's very positive. And I will give you a quick example. NAV, where I worked for many years, helps business owners get financing, and they show business owners their credit information. And the co-founder of NAV, Levi King, he had a situation where he didn't get a bid on a job he was trying to get through his sign manufacturing firm. And it turned out that he had purchased the assets of a business that was going out of business. The owner's son took it over, didn't really care about it, ran it to the ground, and he was purchasing the physical assets of the business. Well, unfortunately, one of the major business credit bureaus associated those late payments with him, as if he had purchased the whole business. And so he had a negative business credit report that prevented him from getting another job he wanted without even realizing that was going on. So if you do acquire another business, you do want to check that business credit. On the other hand, if it's a business that has great credit history or maybe no credit history, then you have the time in business, right? You have when that business started, and then you have potentially that good business credit history. So that could be advantageous. Shelf corporations tend to be ones that are created and put on the shelf and then used later, and they may or may not have any credit history. Just be careful. There are some scams associated that where they spend a lot of money. People spend a lot of money getting a shelf corporation with the promise that they'll get all this credit, and then it doesn't really materialize. Let me give you a third quick strategy. And that is, if you're listening and you're in that stage of wanting to build a business, then officially starting that business, even before you're ready to go full speed ahead on it, gives you that time in business, right? So I met an entrepreneur at a conference. He had a great job in banking, as a matter of fact, but he started a business quietly on the side, just a small little side business. He formed an LLC, and then the 2008 downturn happened. He got laid off. And because that business had been in business for 2 years already, officially, with some business credit behind it, he was able to jump right in, and he grew it to a seven-figure business quite quickly, in part because he had laid that foundation. So you can do your own shelf corporation just by starting your business and taking a few steps that we'll talk about here, so that when you're ready to go in full time or make it more of a bigger effort, you're ahead of the game.
Okay, that's great. So you gave a couple of extra options. And I would say from everyone that I've spoken with that's gone down the shelf route, I've never actually seen it work. I've always heard that it worked,
Mm.
if that's a way of saying it without implying too much or offending people. So
Yes,
you're smart.
in my book, Finance Your Own Business, Garrett wrote about a client he had who spent, I want to say it was at least $80,000. I'm not remembering off the top of my head, but on a shelf corporation with the promise it would give him like $1 million of credit. It did not. So we're kind of leery about that. We want you to be very careful.
Absolutely. Okay, so we have some realistic timelines in place. We've got somewhat of a checklist, and we're not saying it has to be like follow steps 1 through 10, but following solid principles. We're doing this for the purpose of growing the business. What are the other things if we can go into more advanced land? Because I think there's going to be some of our listeners that already have business credit. Maybe they've got contracts with the government, which you definitely have to have pieces in place. And now they're looking at it and they're saying, okay, I really have a lot of revenue that goes through the company and I want to do something much larger, much better. What would you say to that group of people?
In terms of getting financing, I think one of the strongest things you can do is to make sure that you understand the financial position of your company and that you're ready to produce whatever financial statements need to be provided. If your business has strong revenues, good cash flow, good payment history, you have a lot of options available to you. And so your choices are going to be much, much broader than someone who is not at that stage, or maybe is pre-revenue or early, or their revenues are starting to decline. Now, I am a big fan of any type of business having a line of credit available to them, even if you don't think you need it yet. And I do talk to business owners who are very debt averse. They say, I don't need to borrow. My business is doing just fine. But having a line of credit available to you can be, you just don't know what's going to happen. You don't know what opportunity there might be. Right now, we have what's been called a tsunami of people wanting to sell their businesses.
Mhm.
And you might have an opportunity to buy a business or buy the assets of a business, like Levi did in that example, at a very good price. And having some kind kind of financing available very quickly could be really advantageous to you. So in my mind, a line of credit is like the financial insurance policy for your business. The other thing I would strongly recommend is even if you're doing just fine, so you're listening to this and saying, my credit's good, I don't need financing right now, things are fine. I would really recommend you monitor your business credit because of business identity theft. I was a victim of personal and business identity theft in 2020. It spilled over to 2021. It's a hassle. And with business credit, you're much less likely to catch it because you may not even know what's going on unless you're monitoring your business credit, and most business owners don't. So I would encourage you to at least do that so that if there's something that pops up, or if there's just a mistake like Levi had, where they associated these assets that he purchased as if he had purchased the business, you want to catch that quickly and correct it, because someone may be looking at that credit report and you don't know it, and it could prevent some kind of opportunity that you aren't aware of.
Okay. Where is the platform that you suggest monitoring that?
Yeah, the only place I told you I worked at NAV for 6 years and I'm still consulting to them. The only place you can check and monitor all three for free is at nav.com. And then the individual bureaus do sell credit monitoring products. It's not like the consumer credit world where, because there's federal law that gives you free credit reports, there's all these different places you can get your credit report, your credit score for free. It's a much different world on the business credit side. So you just have to be a little bit more proactive and seek out the right solution for checking and monitoring business credit.
Excellent. And you mentioned lines of credit. Is there any place that, again, for our more advanced listeners that have revenue going through, they're established, would you suggest them contacting, forming relationships with banks first, or is it running through NAV's platform? Where would you suggest they start?
Yeah, so certainly your bank could be an opportunity to get a very appealing line of credit. Most bank lines of credit are good terms and good interest rates. And then NAV does have a platform that matches or helps business owners identify financing and find the ones that are a fit based on their qualifications. So it brings the lenders to the borrower as opposed to you having to go out and seek them. So that's another option for you. Right now, there are both online lenders as well as the traditional lenders that offer lines of credit. And some of the online lenders have some quite competitive products now. They've seen the opportunity there. And if you're well qualified, and that's who we're talking about right now, if you're well qualified, you may get some very good interest rates on those online lines of credit as well.
Yeah, absolutely. And to give context for our listeners, in our company, one of the cards that we use is like the Chase Inc. Preferred, I believe it is. And from time to time, they'll say, hey, you can use some of your available credit, which is significant, and you can use that for a line of credit. And if you process through Stripe, they'll proactively send you emails. Again, they're in the neighborhood of 20% in some cases. Some cases it can be lower. But what you're saying, Gerri, is really helpful, because I think we've got two categories of listeners on this podcast. We've got people that are starting and growing, and then we've got real growth. Last part of this conversation, you mentioned the tsunami of people that are selling their businesses, and that's where it's incredibly important. Can you talk about what business owners can do to just get the very most of access to capital in case they want to do those acquisitions?
Yeah, so business acquisition loans have their own process for getting approved, but you can use SBA loans for business acquisition. So that can be an appealing opportunity for business owners who have the time and have the overall qualifications, which are generally going to be acceptable credit, which usually means good credit, 680 to 700. SBA loves to check personal credit. And maybe if there's not enough collateral with the business itself, may include some personal collateral like home equity if it's available. You can't be turned down based on lack of collateral for an SBA loan. So that's one option. And then, of course, there's private lenders who do business acquisition loans, but it's really very much like the qualification we're talking about, where you want to make sure that your business financials are up to date and can be produced anytime you need to provide them to a lender, right? So if a lender does want to see an updated P&L, that you're able to produce that. And I know that sounds very obvious, but I will tell you, Spencer, that during the pandemic, when there were all these pandemic relief loans available to small business, the number one thing I heard from small businesses who were trying to get these loans was, I haven't done my bookkeeping. I haven't done my taxes. I don't have a tax return. I don't know how to put this together. So really having an accounting or a bookkeeping system that's up to date and accurate is one of the best things you can do when it comes to getting financing, as well as having a business bank account. I know we're talking a wide range of business owners here. What I recommend is, if at all possible, run your various income streams through a central business bank account to give an accurate picture of your financials. And here's where it comes into play. You have a lot of e-commerce businesses that may be getting money in their PayPal account, for example, and their PayPal account is almost like its own bank account. But if you have that money come from PayPal into the bank account, then you have it all right there, right? It's in one place. So you don't have to provide the PayPal statements and the bank account statements and maybe some other type of merchant account to that lender. It's all in one place, and it gives a very accurate picture of the financial health of the business. I have a friend who's a bookkeeper, and she tells me some of her clients have 10 or 12 accounts that she's trying to reconcile, bank type accounts every month. And she said it's a mess. They don't know. They don't really know what their business is doing. So it's not that you can't have these other accounts, but you can centralize everything so that you do have one or maybe two accounts that really represent the financial health of your business and make it so much easier to get financing or potentially sell your business.
That's so well said. I love the last piece, which is sell your business. For anyone that hasn't done that, you'll want to have all of this stuff ready before it comes time. If you are not ready, the multiple that you are able to get on your business is going to be lower. If you're not ready, it's going to cost you a lot more money and stress. It's simply just not worth it. This was an incredible interview for all of our listeners, be it if it's someone that's starting out, someone that's in the midst of it, or towards the end, maybe acquiring or getting ready to sell. Incredibly helpful. What should I have asked you that we didn't cover?
I think the one thing that we didn't cover, Spencer, was the simple way to start building business credit, and that's to get some vendor accounts. So we mentioned that, but there are vendors that make it very easy. Don't check personal credit. Do report to business credit, and you can buy things like shipping boxes or Keurig cups for your coffee machine, from these companies, and use those as a stepping stone to starting to build business credit. I recommend, if you're starting out, to get 2 of these accounts, pay them on time each month. Once you've got 3 or 4 months reporting for each of them, then you might want to go ahead and get a third if it makes sense and it's things that you would normally use in your business. But that's really the foundational step. And then getting a business credit card that reports, most of them do report to at least one of the major business credit bureaus. If you do those steps, you're going to be in a really strong position when it comes to building that business credit rating. It's going to do a lot more than you think it will, even with those just initial accounts reporting.
That's incredible. Perfect. And we'll put those resources to the specific vendors inside of the notes for this episode. Gerri, thank you for sharing your expertise and time with us today. This is incredibly helpful. How can people thank you or follow up and ask you questions?
We'll put some links in the show notes. You can visit me at my website, gerridetweiler.com, and there is a link there. You can get a free copy of my book, Finance Your Own Business, if you sign up for a free NAV account with that link. So we'll put that in there as well, and hopefully that will be helpful.
Perfect. We'll do that. Thank you for your time today. It was a pleasure having you on the podcast.
Thank you.